Let's begin today's presentation. Next slide, please. Here's an overview of what we're going to do today. You'll hear 5 minutes from me, overview and background. Then Christina and Laura will speak to the proposed changes to Regulation SX and SK respectively. We'll describe the rule's proposed scope and the phase-in and transitional provisions which are in the rule. And last, we hope to get to some practical considerations for public companies. Next slide, please. And the next one. We've been expecting these rules for a while, so they're hardly a surprise. And in fact, the SEC last addressed climate change or climate-related disclosure in 2010 with an interpretation that essentially extended principles-based materiality requirements to reporting. That was followed in 2016 by a concept release that had discussed or contemplated modernization of Regulation SK and was to address climate change. Literally hundreds of comments were received. In 2018, 2 law professors and investors with $5 trillion of assets under management petitioned the SEC to get going on climate change and ESG. And then more recently still, in March of last year, then acting SEC Chair Lee invited public comments. There was substantial response to that invitation, and there were literally dozens of substantive responses, many of which were actually referred to in the current proposed rules, but ran to dozens of pages. And again, for context and history, the SEC's agenda for 2021 actually suggested that these rules would have been adopted by last October. That didn't happen, but they are out and we're looking at them now. Next slide, please. Of course, many other jurisdictions have or are actively considering similar mandatory climate change disclosure. They're listed here. A majority of large public companies already provide some climate and other ESG information in their non-filed corporate sustainability reports or similar documents. And then most of the mandatory disclosure regimes seem to be coalescing around the use of TCFD-aligned reporting. And obviously that uses the greenhouse gas protocol methodologies, which are in fact proposed under that rule. TCFD has strong support from major financial entities and the G7 and G20. And so it's really being widely endorsed and is again being widely considered as the basis for reporting outside the United States, as well as the SEC's proposal. Next slide, please. Okay, March 21, SEC approved on party line vote the proposed rule. Only Commissioner Pierce dissented. Her dissent, however, is well worth reading. It's a quite elegant piece of work. Formally, comments are due on the proposed rule by May 20 or 30 days after publication in the Federal Register if that's later. I checked this morning, it still hasn't been published in the Federal Register. Given the proposed rule's complexity and the relatively short comment period, coupled by the fact there's a lot of other stuff going on that affect people that the SEC has proposed, we think it's likely that there'll be requests for an extension of the comment period. But candidly, many people also expect the rule to be adopted pretty much as proposed by the end of this year. Having said that, we do also anticipate legal challenges to the rule for, among other reasons, the reasons cited by Commissioner Pierce in her dissent. Next slide, please. It's hard to understate the significance of this proposed rule. It includes extensive and prescriptive required reporting by covered companies of climate-related financial and non-financial disclosures, and in fact requires attestation of the greenhouse gas emission data. Notably, and subject to exceptions and transitions provisions, which we'll discuss, the SEC rules would require all covered companies to disclose direct greenhouse gas emissions, so-called Scope 1, indirect greenhouse gas emissions from purchased electricity and other forms of energy, Scope 2, and if they're material to the company or if the company has set a GHG target or goal that includes them, Scope 3 emissions. Significantly, and as we will discuss in more detail, the requirements include short, medium, and long-term climate-related risk assessments. This is obviously brand new. Those terms aren't defined. The SEC invites comments on what those periods should be perhaps defined to mean, including in the case of long-term, 30 to 50 years. So these are massively complicated and very long-term potential disclosures that this rule will call for. Next slide, please. Briefly, 2 parts to the rule probably. Regulation SK, which is the non-financial statement part, and SX, which is the financial statement part. Significantly, and certainly securities lawyers will be attuned to this, the proposed rule would treat all this climate-related disclosure as filed rather than furnished, as some commenters had actually requested in their responses to then acting chair Lee's request for information or inquiry. It includes potentially significant practical consequences, which we'll also touch on in our thing. In fact, Christina described this rule, I think, quite accurately to me as a governance proposal. And it will be very intrusive, and it certainly could touch many parts of corporate governance, business strategy, and risk management. It does include phase-ins and transitions, but they are not very long. And again, if you haven't been collecting this data, they will be a challenge for you as currently proposed. Significantly, although a point of some debate, is the extension of the forward-looking safe harbor to these assessments. The rule is a little bit garbled in whether you actually could rely on the safe harbor and how safe the safe harbor is. But certainly, again, I think there's an expression that, or a recognition rather, that some of the assessments really will constitute forward-looking statements. Next slide, please. Just touching on the companies that are covered by the proposed rule, it applies obviously to companies with reporting obligations under sections 13A and 15D, companies that file registration statements, foreign private issuers that file annual reports on Form 20F, as well as emerging growth and business development companies. Importantly, the proposal does not apply to Canadian issuers that are filing on Form 40F or asset-backed issuers, that's the term used by the rule. We assume that's issuers of asset-backed securities, but we expect requests for that to be clarified. So with that very brief overview, I'm delighted now to welcome Christina, I think, who's going to talk about some of the proposed changes to Regulation SX.
Thank you so much, Paul, and welcome to everyone joining us today. So we are going to walk through all of the proposed requirements, starting with the proposed changes to Regulation SX. And then we'll turn to the proposed changes to Regulation SK, which, as Paul alluded to, are expansive and extremely detailed. And then lastly, we have set aside time at the end to discuss the practical implications of this proposal and what we think companies should start doing now to prepare. And so, let's see. So as an overview on the changes to Regulation SX, when is this information going to be required? And it's going to be required in filings that require audited financial statements, as well as the corresponding Regulation SK climate-related disclosure. And so that touches on pretty much every form. So Form S1, S11, S4, 10K, and all of the corresponding foreign filings. For where the disclosure is required, the financial disclosure will be required in the notes to the financial statements. We'll go over what precisely that's going to look like. And the what is, it's really broken down into three buckets. There are financial impact metrics, expenditure metrics, and financial estimates and assumptions. So if we could go to the next slide, please. Okay, so before getting really into the substance, I wanted to highlight a couple of defined terms that appear throughout the proposed rules. And there are a lot of definitions included in this proposal, but we'll be using these terms over and over. And so I thought it was important just at the outset to explain what we mean when we say them. So physical risks, that may include harm to businesses and their assets arising from acute climate-related disasters, such as wildfires, hurricanes, tornadoes, floods, and heat waves, as well as chronic risks and more gradual impacts from long-term temperature increases, drought, and sea level rise. Transition risks, when that term is used, it refers to the risks related to the transition to a low carbon economy. So these are risks that could arise from a potential adoption of climate-related regulatory policies, including those that may be necessary to achieve national climate goals, or that may have been adopted in the US or other countries, climate-related litigation, changing consumer, investor, and employee behavior and choices, changing demands of business partners, long-term shifts in market prices, technological challenges and opportunities, and other transitional impacts. So that's the distinction between those two terms that you'll start to see over and over. So if we could go to the next slide, please. Okay, so the first metric that the proposed rules would require would be covering the financial impacts of severe weather events, other natural conditions, transition activities, and identified climate-related risks on the consolidated financial statements. So unless the aggregated impact is less than 1% of a total line item for the relevant fiscal year, you're going to have to start disclosing metrics. So this is going to apply to every line item in your consolidated financial statements. So that includes revenue, cost of revenue, selling, general and administrative expenses, sale of property, plant, and equipment, inventories, intangible assets, long-term debt, and contingent liabilities. So how will this be disaggregated? So, one thing I want to note at the outset here is that, and this is going to be true for a lot in this rule, even if you don't end up having to disclose, you're going to have to go through analysis for pretty much everything that's required to be disclosed. So this is the example from the release itself, this table I have at the bottom that shows how you can make the analysis of whether or not you're going to have to provide this disclosure in the notes to your financial statement. So this example covers cost of revenue. And in the example, the company determines that its cost of revenue is impacted by events A, B, and C, and transition activity D. So specifically, the cost of revenue was impacted negatively by events A and B by $300,000, which was driven by increased costs impacted by severe weather events that strained the registrant's main supplier. This is the example. The cost of revenue was impacted positively by event C by $70,000, which is driven by technology that improved the registrant's ability to manage the impact of severe heat on certain raw materials, which resulted in more efficient production. And cost of revenue was impacted positively by transition activity D, which reduced production costs for certain products by $90,000 through advanced technology that improved energy efficiency during the production process. So note in this table that all of the impacts are added together to calculate the percentage to determine whether disclosure is required. And so, even though there are pluses and minuses in front of certain numbers, those are essentially ignored for purposes of determining whether you've met that 1% threshold that would require disclosure. So you would want to add those all together and determine whether you've reached over 1%. And in this case, as you can see, the percentage impact is 4.6%, and so disclosure would be required. So, okay, so expenditure metrics, that's the next category of disclosure required. So here, you would have to disclose the aggregate amount of expenditure expensed or the aggregate amount of capitalized costs incurred. And then again, it's going to be the same calculation as with the financial impact metrics. It's unless such amount is less than 1% of the total expenditure expensed or total capitalized costs incurred, respectively, for the relevant fiscal year. And so for each category, you have to disclose separately the amount incurred during the fiscal years presented toward positive and negative impacts associated with the climate-related events and toward transition activities, specifically to reduce GHG emissions or otherwise mitigate exposure to transition risks, including identified transition risks. So again, I've reproduced here the table that's provided in the release. And I'll note that these tables are, we note on the slide what page you can find them on. These aren't in the reg text itself. This is in the release. So you have to kind of read through the section explaining the proposed rules to find this. So in this example, the expenditure incurred toward what is event D was $200,000 capitalized, and the expenditure incurred toward activity E and event F were $100,000 capitalized and $25,000 expensed. The amount of capitalized costs equaled the proposed 1% threshold, and thus disclosure would be required for that category of expenditure. But note that no disclosure would be required for the expenditure incurred that was expensed related to event F in this example, because it was below the 1% threshold. So again, this is just an example of, even if you end up not having to provide the disclosure, you're going to have to do the legwork to figure that out. And so it's not as simple as, this applies or this doesn't apply. You still are going to have to do some work to figure that out. So if we could go to the next slide, please. Okay, so this is the third category of new disclosure in the proposed changes to Reg SX, and that's financial estimates and assumptions. So for this requirement, you would have to disclose whether the estimates and assumptions used to produce the consolidated financial statements were impacted by exposures to risks and uncertainties associated with or known impacts from climate-related events. And if yes, you have to provide a qualitative description of how such events have impacted the development of the estimates and assumptions. So again, note that that these disclosures are required in the notes to the financial statement. So it would require a fair amount of narrative disclosure in addition to providing new metrics. If we could go to the next slide, please. Okay, so here are a few points that are just important to know about these proposed rules. So, so the metrics would have to be calculated using financial information that's consistent with the scope of the rest of the consolidated financial statements included in the filing. You also have to apply the same set of accounting principles that are applied in preparation of the rest of the filing. And disclosure for historical fiscal years as proposed, it would be required. So, so there are questions in there of whether that's the right approach, but for now, think of your 10K filing. If you're including historical fiscal years, you're going to have to do this evaluation for those as well. And if not previously presented for such fiscal year and the historical information necessary to calculate or estimate a metric is not reasonably available without unreasonable effort or expense, Rule 409 and Rule 12B21, those are available to these new requirements, or they would be if adopted as proposed. And so that's a consideration that companies can take whether or not they are able to rely on that to exclude the disclosure. So if we go to the next slide, please. Okay, these are just an overall kind of things to think about. The proposed metrics, because they are required in the financial statements, they're going to be included in the scope of any required audit of the financial statements in that relevant filing. They're going to be subject to audit by an independent registered public accounting firm, and they'll be within the scope of a company's internal control over financial reporting. So, that these may be obvious points, but they certainly should not be overlooked because of how important they are. So. So that's the coverage of the new proposed Reg SX requirements. If we could go to the next slide, please. Okay, so now we'll start with the proposed changes to Regulation SK, and I'm going to give an overview. We're going to go kind of item by item to discuss what the substance is. So for item 1501, that's the new 1500 subpart of Reg SK that's proposed to cover climate change. The 1501 covers governance. And here you would describe the board of directors' oversight of climate-related risks. And I give a few examples here, but the text goes into much more detail of what type of disclosure would be required, but I couldn't fit it all on the slide. So, so you would have to identify any board members or board committees responsible for oversight of climate-related risks, whether any member of the board has expertise in climate-related risks, the processes for board discussion of climate-related risks, and then in addition to a discussion of the board, you'd have to describe management's role in assessing and managing climate-related risks. So that includes a discussion of the internal processes for monitoring climate-related risks, the frequency of reporting to the board on climate-related risks, and then the proposal notes that if applicable, a company may also describe the board's oversight of and management's role in assessing and managing climate-related opportunities. So again, much more detail in the reg text itself, but as you can see, it's a lot of disclosure required about a company's not only board governance, but their internal processes as well. Next slide, please. Okay, so So this item 1502, I've got 2 slides covering this one, and I had a lot of difficulty condensing it into 2 slides. There is a lot in this item. I would say that it's comparable to MD&A, but specific to climate change and vastly more prescriptive. And this is especially true given the recently amended item 303 of Regulation SK, which is principles based and encourages companies to provide disclosure that allows shareholders to see the company through the eyes of management. This is nothing like that. This is much more detailed, and so I've tried to cover at a high level everything that this item would require disclosure of. So describing any climate related risks that have had or that are reasonably likely to have a material impact on the company, its business or consolidated financial statements over the short, medium, and long term, specifying whether they are physical risks or transition risks. Again, like in MD&A, you're encouraged to provide both current and forward-looking disclosure here. And as Paul noted, the PSLRA safe harbors are available if conditions are met. You are required to describe the resilience of the registrant's business strategy in light of potential future changes in climate-related risks, providing both qualitative and quantitative information. There is a fair amount of information required to be disclosed regarding internal carbon price disclosure, if that is applicable to your business, and a narrative discussion of whether and how any climate-related risks have affected or are reasonably likely to affect consolidated financial statements. Next slide, please. And then also in response to this item, you have to disclose the actual and potential impacts, including the time horizon of identified climate-related risks on business operations, products or services, suppliers and other parties in the value chain, activities to mitigate or adapt to climate-related risks, including adoption of new technologies or processes, expenditure for research and development, and any other significant changes or impacts. So as you can see, this is very extensive. The reg text itself is several pages long, just sort of delineating exactly what would need to be disclosed in response to this item. So again, wanted to give you a sense of the type of disclosure and how expansive it would be, but we only have the hour, so I had to do it at a fairly high level. But now I want to turn it over to Laura, because she is going to go through the rest of the SK requirements before we turn to some practical considerations. So Laura, over to you.
Okay, thanks, Christina. So I'm going to start on item 1503, and that covers risk management disclosure. It also has a lot of requirements. Companies would have to describe their processes for identifying, assessing, and managing climate-related risks. And among the things that the companies would have to describe would be, how does the company determine the relative significance of its climate-related risk compared to its other risks, and how it takes existing or likely regulatory requirements into account. The companies would have to describe how they determine the materiality of their climate-related risks, including how to assess the potential size and scope of any of the climate risks that it's identified. And when describing the next slide, please, 23, the processes for managing the risk, there's a bunch of things to the extent applicable the SEC wants you to disclose, such as how do you decide whether to mitigate, accept, or adapt to a particular risk, and how do you prioritize which risks you're going to address. What I was saying was you have to disclose how you're going to mitigate, accept, or adapt to particular risks, how to prioritize those risks, and how the company determines how to mitigate a high priority risk. And then if the company's adopted a transition plan, it has to disclose things about the plan, like the relative metrics and targets used to identify and manage the physical and transition risks And the proposal defines a plan, a transition plan, as the company's strategy and implementation plan to reduce climate-related risks. So it might be a plan to reduce greenhouse gas emissions in line with company commitments, or commitments of jurisdictions where the company has significant operations, or it may address risks arising from changes in customer or business counterparty preferences, or maybe technological changes or changes in market prices. The SEC particularly mentioned in this context mitigation plans to adapt to physical risks such as sea level rise, extreme weather events, and the other things that Christina mentioned earlier. To the extent the company has identified those particular circumstances as risks. And some of the examples of the types of disclosures in this area that the SEC is looking for would be production of products or goods or services to facilitate the transition to a lower carbon economy, the generation or use of renewable power, production of low waste or recycled products, setting of goals. And as Paul alluded to earlier, transition planning inherently requires judgments and predictions about the future. So you want to keep in mind use of forward-looking statements in line with the safe harbors to the extent you can comply with all the other applicable conditions. A few other risk management points: if the company uses insurance or other financial products to manage its exposure to climate related risks, they may need to be described. And if there's a separate board or management committee that's responsible for assessing and managing climate related risks, you're going to have to disclose how that committee interacts with the board or management committee in terms of governing of risk. And companies are going to have to disclose total scope 1 emissions separately from total scope 2 emissions after calculating them from all sources that are included in their organizational and operational boundaries. The organizational boundaries are those that determine the operations under control by the company, and the operational boundaries are the boundaries that determine the direct and indirect emissions associated with the business operations that are owned or controlled. And also, as Paul mentioned earlier, if scope 3 emissions for a fiscal year are material, or if the company has set a GHG emission or reduction target or goal that includes scope 3 emissions, it would have to provide separate disclosure for the scope 3 emissions. We'll talk about the phase-ins in a moment. The proposal would require all scopes of GHG emissions data in terms of gross terms, excluding any purchased or generated offsets. And I think we had a question about this point. For each of the scope 1, 2, and 3 emissions, the proposal is going to require the company to disclose the emissions both in the aggregate and disaggregated by each constituent greenhouse gas. So that, if we go to the next slide, just quickly, you'll see what we're talking about on slide 25 for the constituent greenhouse gases. But now let's go to slide 26. I want to talk about materiality. You're only going to have to disclose scope 3 emissions if they're material or if you use them as a target. But assessing materiality for scope 3 emissions, that's a complex issue. And the SEC made clear that while, of course, you would consider and assess the relative significance of the scope 3 emissions as part of the overall GHG emissions, that's only part of the analysis. the proposing release states that even when those emissions don't represent a significant portion of overall GHG emissions, it's still possible that they could be material if they represent a significant risk or are subject to a significant regulatory focus, or using general legal principles of materiality, if there is a substantial likelihood that a reasonable investor would consider them important. And in addition, the SEC indicated that even if the probability of an adverse consequence is relatively low, if the magnitude of loss or liability is high, then the information in question may still be material. So, there's a lot of subjective elements about what's material, and we may wind up finding that companies are being second guessed on that kind of question. When companies are required to disclose scope 3 emissions, they'd have to identify categories of upstream and downstream activities that have been included in the calculation. Next slide, slide 27. As proposed, the emissions data would have to be for the company's most recently completed fiscal year and for historical years included in the consolidated financial statements in the applicable filing. And companies are going to have to describe the methodology, including significant inputs and significant assumptions that they use for the calculation. The scope 1 and 2 emissions would be disclosed in terms of GHG intensity, with separate GHG intensity for scope 3 emissions. And what that phrase GHG intensity refers to is a ratio that expresses the impact of the emissions per unit of economic value or unit of production. Next slide, 28. Everybody knows it may be difficult to obtain and verify data from third parties, and that's where you're going to have to get the scope 3 data. Recognizing this, the SEC proposed a safe harbor for liability for scope 3 emissions that would apply to any of the disclosures pursuant to the new SK requirements in an SEC filing. And what the safe harbor would do, it would provide that disclosures of scope 3 emissions by or on behalf of the company would be deemed not to be a fraudulent statement unless it is shown that it was made or reaffirmed without a reasonable basis or was disclosed in other than in good faith. And it really is an open question at this point as to what constitutes a reasonable basis for reliance on third-party data, especially if the third party is not subject to SEC liability or any oversight of its GHG data. And there can be different methodologies that they've used with different assumptions. So that still remains to be seen how effective that safe harbor is going to be. But the SEC did propose exempting smaller reporting companies from the scope 3 emissions requirement, and it's given all other companies an additional year to comply with the scope 3 disclosure requirement beyond the compliance date for other portions of the proposed rules, and we'll get to that shortly.
So for the attestation requirement, item 1505 is going to require the company, including a foreign private issuer, if it's an accelerated filer or an accelerated filer, to include an attestation report covering scope 1 and scope 2 emissions with the relevant filing, as well as to provide related disclosures regarding attestation services. As proposed, the attestation provider doesn't have to be a registered firm, accounting firm, but it does have to be an expert in GHG emissions by virtue of having significant experience in analyzing, reporting, or attesting to emissions. So what does significant experience mean? It means the person has to have competence to perform engagements in accordance with professional standards and legal regulatory requirements, and enable the service provider to issue reports that are appropriate under the circumstances. In addition, the attestation provider must be independent from the company and any of its affiliates during the attestation and professional engagement period. In terms of independence, the things the SEC will consider are whether a relationship or service creates mutual or conflicting interests, or if it places the provider in the position of attesting to its own work, or results in it acting as management or an employee, or makes the attestation provider an advocate. Other circumstances would also be considered. And the standards that have to be followed must be publicly available at no cost, that are by an established body or group that has followed due diligence processes. That could be the PCAOB, the AICPA, the IAASB, but that's a non-exclusive list. And the company is going to have to disclose information about the provider, such as the license, oversight, or record-keeping requirements. Slide 31, please. As for the attestation, the proposal initially provides for a limited assurance, later scaling up to reasonable assurance. The limited assurance standard is equivalent to the review of a company gets for its interim financials on 10Q. Well, think of the reasonable assurance that comes later as the equivalent to the level of assurance that's in an audit of consolidated financial statements included in a Form 10K. The limited assurance engagements primarily include procedures such as inquiries, analytical procedures, but they don't necessarily include a consideration of internal controls. And that's something a reasonable insurance engagement must do. It has to obtain an understanding of internal controls, as well as to use extensive testing procedures beyond inquiries and analytical procedures. So that would include recalculation and verification of data inputs and inspecting source requirements on a sample basis. Companies can provide voluntary attestations when they're not required to do so, but if they do, they're going to have to disclose information about even those attestations, such as identifying the provider, the standard used, the level and scope of attestation, and a brief description of the results, as well as discussing whether there's any business or professional relationships that may impair independence, and whether there's any oversight inspection service for a provider that has to comply with. But let's go now to 1506 to talk about target goals. And there's a lot of detail there, such as the scope and activities included in the target, the unit of measurement, including whether the target is absolute or intensity-based, the defined time horizon by which targets are supposed to be achieved, and whether they're consistent with goals established by any treaties or laws or regulations. What's the baseline time period against which progress is going to be tracked? And that has to be consistent when you have multiple targets, any interim targets that are set, and how the company intends to meet its goals. So you have to have disclosure indicating whether there's progress being made, and that has to be updated each fiscal year, describing actions taken during the year to achieve the targets. And there should be a discussion of how the company intends to meet the goals. And that discussion could include energy efficiency increases, transition to lower carbon products, purchase of carbon offsets or renewable energy credits, or engaging in carbon renewal or storage. And if you are using carbon offsets or renewable energy credits, that's going to have to be disclosed in terms of how much of your carbon reduction is represented by those offsets, what the source of any offsets or credits would be, description of the products underlying those reductions, and any registries to authenticate them. So quickly moving on to slide 33, I'll just there mention that these new disclosures will require XBRL inline tagging. But let's move on to slide 35 because I want to get to the compliance state. This chart is also from the SEC proposing release. And what I want to focus on is it may not be imminent. It's not your next 10K, but it would be, for example, a large accelerated filer would have to comply with most of the rules by fiscal year 23, which means a filing in 2024, and then the greenhouse would come in later for the scope 3 emissions. And if we go to slide 36, you'll see this is another SEC chart. This is the phase in on the assurance, and you'll see that there's time on here as well for the compliance date. First, you would file, you wouldn't have any of the attestation. Then you would transition to the limited assurance, followed by the reasonable assurance. And while those are all very helpful to have these phase-in dates, don't let them lull you into complacency, because even if we have more than a year before the first annual reports with the new disclosures are due, companies really have to have their procedures, controls, and strategies in place, or at least well underway by the beginning of the fiscal year, or it's going to be very difficult to comply with these rules. And that's a good segue into our final topic, practical considerations. We can move to slide 38. And Paul, what are some of the things you're advising companies to be thinking about?
Well, if you haven't been tracking greenhouse gas emissions and you haven't been working under TCFD and greenhouse gas protocol, you've got a steep learning curve. The methodologies of the greenhouse gas protocol are extensive and replete. Purchased energy in particular gives rise to very significant issues in our experience. And again, companies have some options. You can use various methods, and you have to be consistent, I guess, if you pick a method, but just the way in which those things are determined and calculated is, again, a very steep learning curve for companies who aren't familiar with it and aren't doing it today. I think generally, again, we think this is going to put massive stress on internal resources, including at board and management levels, where, again, you may or may not have people with the necessary climate backgrounds and experience. And again, everybody's going to be going into the market at the same time for the same people. And it's, again, it's going to be a challenge, I think, for a lot of folks to get, as Laura mentioned, their house in order to be able to meet these relatively quick transition periods and requirements. If people want an illustration, just again, one of the things, and I'm an energy lawyer, so I apologize if this is too technical, but corporate buyers of renewable energy have been using a form of power purchase agreement that's financially settled. It's not clear to me that that actually will qualify and be able to be treated by companies as offsets or renewable energy. Again, these are just financial contracts. There's no renewable energy actually delivered and sold. And again, many states don't have renewable energy certificates, so there's no tracking. So there are some pretty significant issues that will have to be worked through for issues like this.
You know, Paul, I wanted to flag, you mentioned you're an energy lawyer, right? Like, this is something we visit the corporate and securities lawyers at the firm read this release, and it was just almost like, well, Paul, what do you think, right? So I mean, this is something that, like, as as a securities lawyer, this is just, it's wild because, you know, I'm thinking through what usually has to be reported pursuant to Reg SK and SX, and this is really just almost like a parallel reporting regime now for public companies. It's unlike anything that they've had to report before in SEC filings. And as I try to emphasize throughout, this is the amount of detail required in this reporting is even, you know, is even greater than that's currently required for a company's business operations. So, I mean, this is, I don't think you can overstate enough how much work this is going to be for public companies and for companies that want to go public. There's no transition for companies that want to enter the markets. This would have to be in your IPO filing. So, you know, and we talked about how this is just as much of a governance proposal as it is a climate related proposal. The detailed information that you would have to provide about board oversight and management's activities in this space, it's incredible. It's just, if you read through the regulations, and for people that aren't used to reading SEC proposing or adopting releases, if you go to the very back, it'll have just the proposed rules, the text of the proposed rules, and so you can sort of read through without all of the explanation provided in the release, but you can read through exactly what would be required, and you can see just it's an incredible amount of detail for this, and I can't emphasize enough that this is something that you have to get started thinking about now, because I think it's you know, the commission has the votes to adopt something in this space, and whether it ends up being adopted not as proposed, I don't think there's much of an expectation that it's going to be very different from what was proposed. So I know, Laura, I think you had a few suggestions of what exactly companies should be starting to think about and actually do right now. Did you want to go over those?
But I want to focus on disclosure controls and the fact that you may need to be adding additional officers or other employees, if they're the ones who have climate change expertise. They're really going to have to be part of the process, and may also need to be part of the process for internal control over financial reporting, because with, you know, these new footnote disclosures in the financials, you know, I think that's going to need people with climate change expertise as well as just traditional accounting backgrounds. And I also think that you're going to want to develop a process to document how you're going to tie the disclosures to related methodologies, particularly with respect to GHG emissions, you know, so that to the extent you have fluctuation as to which employees or new employees might be covering something, there is a process that they can look to. And you want a mechanism to verify that any outside public climate disclosures outside the SEC filings are consistent with the SEC filings. And the SEC does look at other public disclosures. It will look at what's on your website and what you might be saying in an earnings transcript. So there really has to be a holistic approach that is consistent with the filings. And there may be a need to fine tune the allocation of board oversight in the committee charters. So even if you have a company that has a separate environmental committee or a risk committee that reviews climate matters, the new rules do require a note in the audited financial statements, and the audit committee, with its requirements of financial literacy and financial statement expertise, they have to be able to incorporate that disclosure as part of their overview of the financial statements. And so those are things that you know, people could be doing now, looking at their various committee charters, their disclosure control procedures, their internal control procedures, and considering, you know, are you ready? What more do you have to do? And yeah, as I mentioned, when I had the phase-in slides up, there's an awful lot to do, and you can't wait until that, the winter, the first 10K is due, or whatever the period will be, to start putting this together. These disclosures are going to be in a new, at least the SK disclosure, separate section of the 10K. To the extent you have proxy statement disclosures of environmental or things outside SEC filings, it's all going to have to be integrated. As we've been emphasizing, these are complex and detailed rules. And even though it's just a proposal now, if people don't start thinking about it and perhaps even trying to draft sample disclosures to see what would be involved, it's going to be very hard to comply in time. So I don't know if Paul or Christina, there's any other considerations you want to be emphasizing. I know we're nearing the end of the hour.
I think we all have the same message, which is you cannot afford to wait. This is a complex proposal. It's highly prescriptive, and this is, in a sense, brave new world of disclosure for many companies. And again, our expectation, I saw a question to this point, again, market expectation is that the rule is going to be adopted by year end substantially as proposed. Probably will be changed a little, but not significantly. And again, I think you should be working with that assumption. And as Christina and Laura have both noted, again, this just delves into a lot of intimate parts of businesses and processes. If we didn't get to your questions, we will respond to them after. And again, just to remind you, the slides which we will be distributing shortly after the webinar, as well as a link to the recording of today's webinar. So with that, we're going to close. You may all now disconnect and have a great day.